Always a pleasure to be joined by Ron Corser, CFP, your certified financial planning professional resource, ladies and gentlemen, president and founder of Cornerstone Retirement Partners, Grand Rapids, your local resource for a common sense approach and guidance to your financial investment and retirement planning. Ron, always a pleasure to see you. Today, no exception. You have another important topic to discuss.
Well, good afternoon, good morning to everybody listening to today's program. I'm Ron Corser with Cornerstone Retirement Partners. We're going to talk today about 6 stealth taxes that show up in retirement. We're going to talk about when you should start planning for that, and we're going to focus on them because I think it's really important. And when we consider retirement, and that's what everybody is thinking about now, whether you're 20 years old or 200 years old, you're thinking about when can I retire and get out of the dog race and just go have some fun. And the transition from being employed and working and saving to being retired and perhaps not working is a distinct transition. And it's a real transition that people need to focus on. And ladies and gentlemen, if you're getting close to that transition time, say 5 years before or 5 years after, you're always transitioning. Let's be aware that there's a difference. What does that difference mean? You've saved all your life, put a lot of money in a 401k, 403, IRA, everything, brokerage accounts, and you're hoping that will grow, that lump sum. Well, at some point in time, you're going to retire. And then that lump sum has to be what you rely on to give you the income you need for the rest of your life. Whether you live another 10 minutes or another 100 years, you need that to provide the income you need. And when it comes to retirement planning, there's 2 pieces to the puzzle, so to speak, and they're a little different as you transition to retirement. One is you've saved all your life probably using mostly stock market investment things. You can still do that and should do that in retirement because hopefully the markets over time will go up and you'll have some growth in your life savings. But the other part that you didn't worry about before, you have to worry about now, is your income plan. Where am I going to get the money every month coming into my checkbook to do what I need to do in retirement, pay my bills, have a good time? So all retirement planning focuses on those 2 things. What we do really well, and if you're interested in what I'm talking about, give us a call here at 616-301-2581. That's 616-301-2581. Or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you with your questions. So when we talk about the distinction between, well, I'm working and then you transition into retirement, it really focuses on 2 things. How do you make your money last, and how do you protect the money that you worked so hard to save? Everybody who's retiring now or close to retirement has probably experienced 2 dramatic collapses in the market. One was 2000, 2003. The other one was 2008. And that's hampered how we think about investing and what we try to do. And it brings up a little bit of a fear element, I think, even with the most storied, intelligent investor. So how do we create investment plans and income plans in retirement that'll last longer than we do? How do we create in our retirement plan and account for when one spouse dies if you're married? How do we do that? Because it always impacts your income. So one of the things we're going to talk about, and we're going to focus more on the income planning part, are taxes. Next to healthcare, taxes are probably going to be the biggest expense we experience in retirement. So if I've already hit a hot button with you, please give us a call at Cornerstone Retirement Partners. Ask for me, Ron Corser, or our Managing Director, Nolan Gosley. Call us at 616-301-2581. That's 616-301-2581. We will reach out to you and help you. It's that important. It really is. Most times when we talk to people who are really close to retirement, The question all is, what do I do? How do I access my money? What are the chuck holes in the road of life that I have to be aware of? And one of the biggest chuck holes is taxes. So we're going to focus today's program on taxes. There's a lot of other things we can do, but I think this is really important. So stay tuned. Give us a call at 616-301-2581 if what we start talking about or what I've already talked about has kind of hit a hot button with you. So let's talk about 6 stealth taxes. They've been around for a long time. And what are they? They're taxes that we don't think about or see very often. You think about it when you're working, you look at your paycheck, and there's something called FICA. And there's something called taxable income at the end of the year. You get 1099-Rs or 1099s. Every investment idea, every investment strategy, every investment vehicle has a tax plan attached to it. And it's important to understand those things. So let's go through the 6. The first one is something that's kind of new, and that's how inherited IRAs are treated in the tax world. This is a new one that came up with the Secure Act, and it's permanent. It does a couple things. Number one, let's just think about you've worked so hard, you and your wife, if you're married, and that you come to the end of your life, and you still have money in the bank, money in your portfolio, and you want to transition it to, say, children. How do you do that? How do they know what to do? That's the real key thing, is whoever's the beneficiary of your retirement accounts, how do they really know what they have to do with it? So let's talk about this. Generally, and it is now, that it used to be when you died, you could pass along assets to non-spouses, and they would have the ability to stretch the IRA required minimum distributions for their lifespan, their whole life. So if you left your 45-year-old son part of your IRA, he'd have almost forever, as long as he lived to be 140, to draw down that beneficiary IRA. Well, things have changed. Now, what we call a non-spouse beneficiary. And who is that? It's not your wife or your husband. It's not some child that's under 18. It's somebody who's inherited your IRA. They now have to liquidate or empty that IRA in 10 years. So it's not a bad idea to remember that when you're structuring your legacy plan. If you're going to give money to your children, grandchildren, whoever it is, they need to understand the tax rules behind that. And the 10-year liquidation rule is really critical to understand. So how you use that, how you lay it out in your legacy planning, talk to us. If you need more information, Nolan and I, we rely on a guy named Ed Slott, who's the 900-pound gorilla in the IRA planning world, and we're master lead advisors with them. We can help you. We can help you structure a legacy program, your beneficiary documents in such a way that what you work so hard for is passed on to your beneficiaries in the most tax-advantaged manner to minimize taxes. So that's the first rule that's changed, is how do we pass this on to what's called non-spousal beneficiaries? Do they understand what's going on? Now, this rule here is really set in concrete. It's not going to change. So one of the things to understand is you might as well deal with it now. A lot of times people say, well, I'll just leave it to the kids and they can deal with the taxes however they want. And I understand that, but it's always a good idea. What I say to our clients is, let us help you with your children. Introduce them to us. We can have a conversation with your approval and with you being in the room about how this is going to happen when you die and what their options are going to be. It makes all the sense in the world to do that. So if this is important to you, give us a call at 616-301-2581. Ask for me, Ron Corser, or our managing partner, Nolan Gosley. We can take you through the rules, the regulations, and all of that to deal with how do I pass the money on in the most tax-advantaged manner. So that's the first one that comes to play. The second one, and this is the one that sometimes gets people a little angry, is the taxation on Social Security benefits. this kind of makes people frustrated because we paid tax to put money in the Social Security system. And now the government says, well, you may have to pay a little more tax when you take it out or you access your benefit. I'm not here to say whether that's right or wrong. I'm here to say I think it's absolutely wrong, which is different from just being wrong. I tell people we've already paid enough taxes in our life. Why do we have to keep paying more? And the answer to that really is because the government needs our money so they can spend it. So when it comes to income planning and retirement planning, having a strategy on accessing your Social Security benefits, particularly if you're married, is really important. Even though Social Security has changed some of the options that we have, it still makes a great deal of sense to understand what some of the strategies are. Should you take it early? Should you take it late? When is the best time for me to take it? When do I need income from it? What is it going to do to my taxable income that I already have? It's important to understand that, and we can help you with that. We can do a Social Security analysis for you that'll show you up to 5 different options. And when we do retirement income planning, we always talk about in a very kind of serious, simple way about the tax implication of what you're going to do. So if this makes sense to you, if you want to know what maybe the 5 or 6 options that you still have with Social Security is, give us a call here at Cornerstone Retirement Partners, 616-301-2581. That's 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there and we'll reach out to you. It's really important that the Social Security planning and the retirement income planning work together. They're not separate. They're different. They're not separate. So it works together, and we can give you the best opportunity to maximize your benefit and also the best opportunity to potentially minimize the taxation on your Social Security benefits. And always keep in mind that part of the Social Security issue goes to number 3, and that's Medicare. Everybody gets to be 65 or older, becomes what I jokingly call wards of the state. We get to rely on the United States government for health care, different kind of plans. In our firm here at Cornerstone Retirement Partners, we actually have a whole team that does nothing but deal with the healthcare issues, meaning they can do all the Medicare options and planning for you. They have, if you're not 65, what kind of information do you need to make a good decision on getting healthcare before age 65, and Medicare is there. It makes us kind of interesting and unique in this business here at Cornerstone Retirement Partners. But we think that healthcare planning and tax planning are really the 2 biggest potential expenses. That's why we plan for them in retirement. So if you need help figuring out what we should do on our Medicare benefits, give us a call here at 616-301-2581. Ask for Nancy Corser, her staff. They're incredibly gifted and talented. They will go through all of your options. And when they're done with helping you, you will have made an incredibly sound, wise decision. They're that good. So give us a call here at Cornerstone Retirement Partners if you want to talk about your Medicare benefits and how to take advantage of them. 616-301-2581. Remember, in retirement, the 2 biggest expenses we're probably going to face: healthcare costs, and I'm not talking about going into the facility, long-term care. That's a separate cost, and taxes. So we're going to talk about the taxes here as we'll deal with this. Another thing to remember when it comes to how do we deal with Social Security, how do we deal with Medicare, is that the Medicare Part B premium, if you're on the Medicare system, that's going to come out of your Social Security payment. So you need to understand that, because it's going to impact, right, how much money you're going to have everyone coming in. So if the government's going to extract some money because of your Medicare payments, you have to make that income up somehow. And that's why income planning is such an important piece of what we do here at Cornerstone Retirement Partners. So give us a call here, 616-301-2581. Ask for me, Ron Corser, or Nolan Gosley, if you want to talk about the investment side, put together an income plan. And if it's just Medicare issues, healthcare, getting insurance, give our team a call here, Nancy Corser's team, and they will schedule a time for you to go through it. It's not a simple 15-minute conversation, but it's a good one to have with our firm. So that's number 3. The fourth one is a net investment tax. This is kind of a tax that it's stealthy in that not everybody's subject to it. What is the net investment income tax? Well, it's a tax. It's really a surtax up to 3.8% on your income that's been around for a while. It has to do with interest, dividends, and capital gains. If you make a little more money than the government is happy with, they will add an additional tax onto you. This 3.8% is on top of everything else that you do. But it has to do with how do you deal with your assets, particularly before you retire. You know, there's a lot of work that can be done prior to retirement when it comes to creating a tax strategy within your income plan. And we're good at that. We know how to do this. And this net investment income, it doesn't impact everybody. It impacts primarily higher income wage earners or people who have done a really nice job of investing and been blessed with a big nest egg. But it can have a really serious impact on your lifestyle and require you to spend down your assets a little faster than you intended to. So that's another stealth tax to be aware of, and it's something we can help you at least uncover. Then this next one here, we call it number 5, the widower or widower's income tax penalty. This is one of the stealthiest taxes there is, and I tell folks when there's a death and once it goes from 2 married people to 1 married widower person, the tax issue becomes potentially kind of ugly. Why is that? Well, all of a sudden, instead of married filing jointly, you're single filing in one individual return. That means that the barriers, if you will, the levels of taxation potentially go much higher, much faster, because you don't have the ability, to take advantage of, say, the maximum benefit of $30,700 for deductions. Now it's reduced. You have a reduced Social Security benefit because one spouse, when they die, the surviving spouse loses a Social Security benefit, either hers or his, depending on which is the smaller. So that's like taking a cut in pay, which impacts income. So think about this. You know, I love it when the government says we really care about you. If you want to find out if people really care about you, see what they do to your wallet and life savings. So as a single person now, all of a sudden you're subject to lower amounts that can be protected or written off for taxes. You're subject to having less income because you lose a Social Security benefit. And on top of that, what you pay in tax may actually go up, which is really scary. So one of the things we do when we help income planning for retirements is we factor in the uncomfortable what if we do that. What if one of you pass away? What happens to your Social Security benefit? What happens to your income plan? Is the income plan built tough enough to survive something like that? And we do our very best to make sure that it's called survivorship income, that if it's your wife that needs the income, we do the very best we can to make sure that the plan still works when you have this major event happen when one spouse dies. So this is important stuff. And lastly, we're going to talk about state taxes. Now, let me back up. If you're able, and you're one of those people that are able to itemize your taxes, you're allowed to write off state local taxes up to $10,000 a year. When they made these changes in 2017, basically what it did is it eliminated quite a few people from the tax rolls of itemizing deductions. The standard deduction became a bigger and a better option. But there are still people, particularly higher income people, that can write off state and local taxes, that kind of thing. Right now, it's limited to $10,000. So that means if you have property that is valued at more than that, you may be limited in how much you have to write off and how much you have to keep and just kind of swallow when you do your taxes. Now, this was part of the income tax rules that went into effect in 2017. So those are going to sunset in about 10 years, or 2027. And it'll change. I don't know how it'll change, but it will change. That simply means is everything's going to go back to where it was in 2017 unless Congress makes a change. And that could impact how you file your taxes. So, ladies and gentlemen, we've kind of highlighted 6 stealth taxes in the great retirement planning scenario. So think about this. When it comes to planning for your retirement, it's not something you do on Monday because you're going to retire on Friday. It really should be something that you deal with 4, 5, or even 6 years before that date comes. We live in a time now where there's a lot of uncertainty. So we've got a lot of clients who planned on retiring at a certain date, say 65 or 66 or 70, and there were changes in their companies, and they're retired now sooner than they thought. So when it comes to planning for your retirement, yes, it's a good thing to plan on. We got to save more. We have to hope the market goes up. But it also makes great sense to start planning an income plan. How much money are you going to need when you retire to maintain your lifestyle? And that planning realistically should start 3, 4, or 5 years before you're going to retire. Now, here's the advantage of having that plan in place, even if you're still working. What happens if the boss comes to you and say, we've got to make some changes? If you already have an income plan in place that's kind of built around the idea that no matter when you retire or are forced to retire, here's how much income is going to be available to you on a monthly basis from all your different accounts. It gives you a sense of security, knowing that, hey, you're probably going to be all right if you've done the planning with us. We can adjust things to have these events that happen and come into your life impact your lifestyle. So retirement planning is not something you do 3 days before you retire. It should be done a lot later in your working life, but about 3 to 5 years beforehand. Get all the facts, get all the things put together. We're happy to do that work for you, even though you're not in a position to retire for 3 to 5 years. But if you have a plan now, isn't that going to be a little more comfortable and give you a better sense of security, knowing that no matter what happens out there, we have a plan and it's flexible enough to help us do whatever we need to do to maintain our retirement lifestyle and to get through something that may be catastrophic in terms of your planning. So, ladies and gentlemen, I'm Ron Corser with Cornerstone Retirement Partners. Thank you for listening to what we have to say. If you're interested in retirement planning, healthcare planning, figuring out what kind of income you need and how you're going to get in retirement, please give us a call at Cornerstone Retirement Partners here, 616-301-2581. That's 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you get the information you need to make great decisions as you approach retirement, or if you're in retirement and you need a second opinion on what's going on with your life savings. Give us a call, 616-301-2581. Thanks for tuning in. Look forward to hearing from you. Again, I'm Ron Corser, a certified financial planner with Cornerstone Retirement Partners. If you've enjoyed today's program and it's piqued your interest, I invite you to like, share, subscribe, or comment on what we've done. And give us a call again at 616-301-2581. Cornerstone Retirement Partners, www.cornerstone-rp.com.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.